If you've got a 401k, there's a really good chance you're invested in something called a target date fund. It's that classic set it and forget it option designed to take care of your retirement savings for you. But is putting your entire financial future on autopilot really the smartest move? Let's dig in. Okay, so let's get right into it. We're starting with the whole reason these funds exist in the first place: to automate what is, for most of us, one of the biggest and most complicated financial decisions of our lives. So let me just ask you straight up. Is your retirement on autopilot? When you first got automatically enrolled in your company's 401k, you might have been put into one of these funds without even thinking twice about it. And that's by design. They were created for all the people who felt, maybe a little overwhelmed or just not equipped to make these huge investment choices on their own.
So what is a target date fund exactly? Well, think of it as a portfolio that basically manages itself. When you're young and have decades to go, it's pretty aggressive, packed with stocks to try and maximize your growth. But as you get closer to that target retirement year on the label, say 2050, it automatically starts shifting your money into safer stuff, like bonds. This whole setup became the go-to default option after the Pension Protection Act of 2006, which really pushed companies to get their employees enrolled automatically.
And just to give you an idea of how big this is, we're not talking about some niche little product. Oh no. Investors have put over $2 trillion into target date funds. That's trillion with a T. So yeah, understanding how these things work is absolutely crucial for millions and millions of people. So how does this automatic adjustment actually happen? Well, it all comes down to a really cool concept with a name that sounds like it came straight out of pilot school: the glide path. And that name, the glide path, is a perfect metaphor. Seriously, think about it like your retirement's pre-programmed landing sequence. It's designed to bring your nest egg from that high-altitude, high-growth phase all the way down for a safe, stable landing right at your retirement date. Now, take a look at this chart. It shows the whole journey so clearly. See the bars way over on the left? That's when you've got, say, 40 or 45 years until you retire. Your portfolio is almost all that dark ride high-risk stuff. We're talking stocks. But just watch what happens as you slide your eyes to the right, getting closer and closer to retirement. You see the blue, safe, and green low-risk sections start to totally take over. That, right there, is the glide path in action, automatically de-risking your money as you get older. It all sounds pretty simple and logical, doesn't it? Well, this is where the plot thickens. That whole set it and forget it promise, it's got some pretty important fine print. Because here's the catch. It turns out not all autopilots are programmed the same way. Different companies that create these funds have very, very different ideas about what a safe landing actually is. And those differences, they can have a massive impact on your savings. And wow, this chart just lays it all out there. It compares the glide paths from 3 major target date fund indexes. Look at how they basically follow each other, almost perfectly for decades. But then, as they get close to that target retirement date, right when they enter that critical risk zone, they just completely split apart. That blue line, the SMART index, takes a nosedive in its stock allocation, getting much safer. Meanwhile, the S&P and Morningstar indexes stay way more aggressive. So why the huge difference? What's going on? Well, it really comes down to 2 totally different philosophies. The S&P index, it takes what's called a consensus approach. It's basically just an average of what most funds are already doing out there in the market. It's like following the herd. But the Morningstar and SMART indexes, they take a normative approach. They're built on financial theory, on what experts think investors should be doing. So it's the difference between common practice and, well, best practice theory. And this brings us to the most critical part of this entire flight plan. We're talking about those few years right before and right after you retire. This is where the specific programming of your fund's autopilot matters more than ever. This quote from financial planner Joe Curry, it just says it all, doesn't it? A big market crash right when you stop working can be absolutely devastating. And it's a risk that a lot of these target date funds might not be protecting you from as much as you think. This risk zone is when your portfolio balance is probably at its all-time high and you're just about to start taking money out. And as you can see here, the big 3 providers, we're talking Vanguard, Fidelity, and T. Rowe Price, they all keep about 55% of your money in stocks right at your retirement date. Let that sink in. Over half your money is still exposed to the ups and downs of the stock market during your most vulnerable years.
This all leads to this crucial concept called sequence of returns risk. It sounds a little technical, but it really just boils down to having some really, really bad luck. If the market tanks right after you retire, you're forced to sell your stocks when they're down just to pay your bills. And that permanently hurts your portfolio, making it way harder to recover and meaning your money might not last nearly as long as you had planned.
Okay, so we've laid out the potential danger here. But the good news is you're not helpless. There are smarter strategies you can use to build a much safer landing sequence for yourself. One really powerful strategy is called the bond tent. I love that name. Think of it like you're building a financial shelter to protect you right around your retirement date. So step one, about 5 years out from retirement, you start moving more and more money into safer bonds, building a nice cushion. Then, step two, for those first few years of retirement, you live off that bond cushion, which lets you leave your stocks alone to hopefully ride out any market turbulence. It's basically a shock absorber for your money, right when you need one the most. And then, here comes the part that might sound a little strange at first. Step three is what's called a rising equity glide path. After you've made it safely through that initial retirement risk zone, you actually start increasing your stock exposure again. I know, it sounds counterintuitive, but research from experts like Michael Kitces and Wade Pfau shows this can actually help your money last longer by fighting off inflation and giving you more growth potential in your later years. So after all of this, it all comes back to one person, you. The default settings in these funds are one thing, but what does your personal flight plan need to look like? This data is so interesting. A study by MassMutual just asked investors, what's your main priority? 15 years before retirement, 75% said growth. Makes sense. But look what happens right at retirement. That number plummets to just 17%. People's focus shifts massively towards safety. Now compare that 17% who want growth with the 55% stock allocation that the big target date funds are holding. You see the disconnect there? It's huge. So here's the bottom line. Target date funds, they're incredibly powerful and convenient tools that have helped millions of people save for retirement, but that one-size-fits-all autopilot might not fit you. It might not line up with your personal comfort level with risk, especially during those super critical years, because ultimately, you are the pilot. So I'll leave you with this one last question. Your target date fund has a flight plan. It was pre-programmed for you by someone else based on averages and financial theories. But is it the right one to get you safely to your destination? It might be time to take a look at the controls.